Okay, good evening, everyone. Hope everyone had a great day today. We're here back again for our weekly Silicon Valley real estate market update. My name is Robert Cruz with the Lutz & Cruz Group, powered by Place at Cupertino. And as we do every Thursday, we do a refresh of what has happened the last 7 days in our real estate markets. And if this is the first time you're hearing this via whether live or re-recording, it's important to note our markets move so fast, we can't wait for 30, 60, 90-day old data to come out, which is typically what you get when you're looking at national information, which is not to say that it's wrong information, but if you're thinking of buying or selling, you need more up-to-date information, you need more localized information. And then what I'll show you in a minute is we use our experience and a background of over 20 years here in Silicon Valley to really show you what are we looking to have happen in the next 30, 60, 90 days, which in my experience is really what buyers and sellers are looking for when they ask us the question, what's going on with real estate? So as usual, I'm gonna try to keep it short. This is not designed to be a deep dive into every single market in our valley. Concentrate on Silicon Valley and the major cities and areas in our market, but it is designed to show you how we reach the conclusions of what we think the market's doing, how we think it's working, where it's going, so that when you have those particular questions about your property or your condition or your thinking, you can have that ability to call us up, set an appointment, and we'll do a deep dive into your local market, even into your neighborhood and your property, to help you make decisions around buying or selling. So with that, I'll jump right in. And as usual, you know, we have a couple things that we're always looking at. Demand and supply, of course, those are the primary factors that drive prices in our markets. And then what we do that is very unique here for us is we measure the speed of the market. And supply and demand, everybody kind of understands how those two things work together. If demand is high and supply is low, prices go up. If demand is low and supply is high, prices can go down. But the factor that really has come into play in our markets over the last 3 or 4 years is how fast are these homes selling? How fast is it from putting on the market to showing it to buyers, getting offers, and getting it sold? The faster that process moves, the higher the drive on and pressure on prices upward. So, and then when all three are in alignment, prices move really quickly and go up high. That's why you've seen so many periods over the last 3 or 4 years when you see values or prices of existing inventory going 10, 15, 20% over asking price. So we'll explain a little bit about how that works and what you need to look for and what we can help you with to understand that. So the first thing is, one of the things that we always look at as a team is what is the state of the buyer? What is the number? What's their appetite? How are they feeling? And one of the best ways to measure this and early on is how many people are applying for mortgages. We know that regardless of what else is going on, if the number of people applying for mortgages is rising, then ultimately demand on any existing inventory will go up, no matter what the starting point is. Obviously, we've been in a low supply market for many, many years here in Silicon Valley, 2021 and 2022 being two of the lowest inventory markets ever, and 2023 showing some movement upward on that inventory list. But as you can see on the far right of this chart, around April, May of 2022, the number of people applying for mortgages plummeted. No surprise in hindsight, when interest rates go from 3.5%, 4% to upward of 7% around this period, buyers put a brake on their buying activities. They really stopped going out and looking or making offers on properties. But we knew that because we saw immediately the number of people applying for mortgages drop in this period year over year by 30, 40%. And so it wasn't a surprise that the buying market weakened. because we looked at this forward-looking data. Conversely, around mid-November, we started to see that the week-over-week purchase applications started to go up. Now, in the middle of an overall big dive like this, small single-digit week-over-week increases don't seem like a lot. But remember, this is a national number showing the overall mood and trend of buyers in the market. And then in our specific market, with millions of people living in the Bay Area, in the greater Santa Clara County area, we only have 600, 700, 800 homes on the market. So it's important to understand, don't misread small incremental week over week gains in purchase applications as not enough to move the needle. It absolutely does. And now again, we can see over the last 7, 8 weeks, it absolutely has. Our markets have been very tight. Inventory has been very low. Buyers have rushed back into the market, multiple offers on properties, driving prices higher and higher week over week and month over month. So we still have a year over year 31% drop, but that is the smallest decline since September of last year. So we kind of see that trend reversing. We see that big drop that brought us to levels not seen since early on or mid 2010s, and honestly higher or equal to the bottom of the great financial crisis. That can be a sobering view when not viewed in proper context. So I like to point this out. We've been doing it week over week. As long as we see purchase application data tick up, even if it's small single-digit increments, we're starting from a healthy number of buyers in the market. So that starts to show buyer demand at least constant, if not rising. And this is usually an indicator for the next 30 to 90 days. So here we are, mid-April, number of applicants still rising. That should give us more than enough impetus to go through the rest of the spring and start of summer with good buyer demand out there. So that's the demand side. What about the supply side? This is a very interesting story. This graph from Altos Research shows national numbers, and they write 18% fewer new listings each week than last year. And 25% of those went into contract within days of listing. Plenty of demand for the existing supply. It makes sense why home prices are stable, even though we will have significantly fewer transactions this year. So again, this is national news. The headlines here are the number of new listings coming to market keep trending lower each week versus last year. Again, last year was a very low inventory environment. And also important, 25% of those new listings immediately get purchased, going to contract within days of listing, not 30, 60, 90 days of inventory, but days. I'm going to show you the next slide, what's going on specifically in our county, and then bring into more relief. What does it mean? How is the number of new listings affecting total inventory? And what does the ones that go off and get sold really, really fast, how does that affect how we're shopping for houses? So here we are, Santa Clara County, last 15 months. The bars are a number of properties for sale in each of the given months. And the blue line notes how many new properties come to market that month. So a couple of really important things where I kept the text up there because it was 18% fewer new listings each week. You can see here, new listings in Santa Clara County in March were around 1,500. March of last year, we had 2,500. So 1,000 or about 33% fewer new listings coming to market this year. The trend here for the bar here is number of active listings in March, again, around 1,500. Last March, it was only 1,300. So that's around a 10, 12% gain overall year over year in a total amount of inventory. So here's where we start to really pull apart what most of you are hearing or reading in national news or 30,000 views of the market. Rise in inventory, more choices, more opportunity for buyers. That generally should be positive for buyers in terms of more things to look at, more properties to look at, maybe pressure on prices will lower. Here's a reality on the ground. You can see that the first part of last year, first quarter, we started low inventory and we rose quickly up to almost 3,000 units by July. We have started higher this year. We started with 1,470 versus 854 in the county, but that's total inventory of what's available for the entire month. And you see it's remained flat because new listings trended very low over the fourth quarter. And although they took their traditional rise in January, February, and March, we weren't at the same rate we were last year, consistently 50%, 30% below last year's new inventory. So how is that possible that the number of new listings is declining and the overall inventory is rising? This goes to that metric of 25% of the properties going off the market right away. The buyer in this high rate, high price market is looking for the turnkey property, a new property to the market in the nice neighborhoods, nicer neighborhoods with little to no upgrades needed in the property. That's what we term turnkey, are willing and able to pay these prices. And there's competition for those. When you see headlines right now of home selling in the first week, 50 to 100 people at the open house, 5, 10 offers per property, going way over asking price, that is on that select group that is turnkey ready to go. They go fast. They don't make it into month 2 of inventory. They're recorded once as new inventory, once as active, and then they're gone. So that starts to explain why inventory is rising with so few new properties coming to market. If you're not in that first wave of the most desirable homes, you're going to last 2 weeks, 3 weeks, 4 weeks, maybe even into the second month. And that's where we start getting the reading of increased inventory. So do we have more homes for sale than last year? Yes. Are they the homes that most buyers or the most active buyers are wanting? No. So you're having a bifurcated market. One where brand new listings, well priced, with the amenities that people are looking for, in the condition people are looking for, go very fast with a lot of competition, pushing the price up. If the home doesn't meet all those conditions, it's lasting. If there's any value for buyers out there in this market, it's there. An impolite term, but scratch and dented. You know, if it's not going in that first weekend, it has the potential to last a little longer and potentially for you to negotiate and get a good price on the property. All right. So very important. And then how does that playing out in our numbers here? So again, here is Santa Clara County single family residents over the last 15 months. We do some very simple analysis visually as much as anything to help you really understand how do we arrive at values of properties. The first thing we're looking at, of course, is what is the market doing? Is it going up? Is it going down? Is it flat? Once we establish that, then we look at your individual property, whether you're thinking of selling it or buying one. And within the context of the market, how is that property stacking up against others? What is its condition? What is its age? What is its relative value? To really get you a good idea of what is the pricing associated with that particular property. So general trends, again, when we look at this, the first thing I look at is the number of new homes coming to market. That's the blue line pendings. New listings. And the red line is the number of properties put under contract in that month. Whenever you see these two lines trending towards each other, if not overlapping, that is a condition where prices are tending to be pressured upwards. As soon as they come to market, they're sold. High competition, multiple offers, pushing the prices up in that competition. When these lines start to move apart, that indicates pressure on prices downward, or if not downward, at least stopping the rapid increase of prices that we see in these highly competitive months. Now, this is a great indicator here because, again, around this time period, after a very hot start to our market, interest rates went up by, from 3.5 to almost 7. In fact, it hit 7 right around mid-June or July. And so with that rapid increase in rates, you saw buyers really pull back from the market. They didn't disappear, they still purchased homes and they still made offers and were accepted, but not at the rate they had been. Meanwhile, as sellers saw that, they started to hold back from putting their homes on the market. They saw we're no longer getting multiple offers. We're no longer getting way over asking price. I've got a lot of equity in my house. I don't want to lose it. I'll keep it off the market and I'll wait for next year or next spring or whatever. And so you see the number of new listings start to decline rapidly all the way down to a very low number, which again, we have not yet recovered from. We're still trending, even though in our first quarter upward trend of new listings, we're still trending lower than last year. However, around August or September, as more properties came off the market, the buyers that were still in, who were expecting dramatic price drops, realized they won't accept our offer. They won't sell it just because national headlines are talking about prices falling. So some sellers completely got out of the market. That dramatically decreased the available supply in a market, again, even with higher rates and higher prices. If you felt you had to buy, then you had to negotiate with the few sellers available. That created some impetus for the market to start rising again. Again, mid-November, we know that buyers capitulated to the current market because they went back to their mortgage lenders and asked for loans. Again, around mid-November, more and more people started to come back into the market and applying for mortgages. And so then you see from starting December, January, February, March, that tightening of the blue and red lines, pressure on prices up. Now, we are almost midway through March, so it's always nice to see what do we see so far. And what we see here is the number of properties for sale around is flat. Typically, they rise from March to April. We're not seeing that right now. We're seeing it rise at the same rate that it rose in March. Atypical. Inventory could begin showing that it's going to fall. A lot of that's driven again because the new listings have declined so dramatically. You usually see from March to April, this go up and flatten as we start to enter summer. You see that flattening, a little slight drop here from March to April. Here it was 60 units, which is about 4 or 5%, 6%. We're seeing almost a 34% drop from March to April in new listings. So low inventory, fewer and fewer buyers deciding to enter into the market. There's no relief there in number of new properties on the market. So supply showing that it's not being replenished, staying really, really low at or near and potentially in the near future below last year's numbers, while demand has, after a really big dip from May to November, started to creep back up week over week, month over month. And so what we're seeing here is, although the number of solds is less, you can see the decline in number of solds is nowhere near the decline in new listings, that premier property that most buyers are looking for. So while this is a drop, it's not as heavy as that drop. So when something comes to market and it is desirable, there are plenty of people for it, and they are moving prices upward very steadily. And then of course, pendants here, that's a very flat number. But again, when we dramatically reduce the number of properties, or at least the premier properties that buyers are looking for, you can't sell what doesn't exist. So if we continue to see this drop in new listings, we can see pendings flattening, but don't misread that as a weakening in the market. And let me show you what I mean by that. The second thing we really like to share with you, again, when you're doing a one-on-one with us and we're trying to establish what is the market doing now, this is a forward-looking number, the absorption rate based on pendant sales. What this does is it measures for any given month at any given point, how fast are buyers soaking up whatever is on the market. So the absorption rate is simply, if there's 30 days in a month and we have 30 listings and they all sell in that month, we have 100% absorption rate. If they all sell out by the 15th of the month, we have 200% absorption rate. If we only sell half by the end of the month, we have 50%. So you can see it's a measure of what is the buyer's appetite in the current market. And again, after a very fast start in the beginning of last year, when interest rates dramatically increased, buyer demand cratered. Now, mind you, anything above 33% is a seller's market. So in the midst of that drop, I was saying prices are not going to fall, prices are not going to fall, because I knew as long as it stayed above 30%, as long as we have healthy, maybe not record time, but healthy buyer demand, we would be okay with prices. And we maintained around that all the way until, again, about November. And then we got a nice bump in December. And then we rose, which we traditionally do in January, February, and March. But this was unexpected. We thought with interest rates what they were, that we would maintain around this 50 to 70% mark. But buyers surprised us. They rushed back in. And you can see they rose to very healthy absorption rate numbers. Now, as we teach, as we demonstrate, when the absorption rate goes up, when new inventory goes down, and pendings rise, all those conditions create a very fast market and pressure on prices upward. So let's show you what that looks like. This line here measures the sales price versus the original list price. So did it go for more or less, or what the seller was asking for? Last year, we started, again, 10, 15, 16% over asking price. Very, very heavy seller's market. Buyers were competing heavily against each other, driving prices up. When when interest rates rose and made it so that much more expensive to buy, buyer demand waned and started to drive the pressure on prices downward. So even through the third and fourth quarter, sellers were getting almost exactly what they were asking for. It dipped to its lowest in December and January of this year, only 94% of asking price, but immediately shot up with those absorption rates as leading indicators to 99 and 100%. Through the first 2 weeks of April, we're up to 3%. That's significant because remember, we're talking about median prices around $1.7 million. So a 3% increase in the sales price to list price ratio is $60,000, $70,000 on average to the mean product. And so very quickly in 15, 20, 30 days time, we're seeing that 60, 70, 80, 100, $150,000 increase in home values in our market. So that's what we look at. That's what we use to look at what's been happening in the most recent trends in our markets. And then again, when we sit with you, when we start to look at what is your condition, what are the things that you're looking to do, whether it's to buy or sell, we can synthesize that down into your local market. If it's a condo or townhome, if it's a larger home on the block or smaller home on the block, and we'll take that 30,000 foot view, we'll tighten up the parameters. So we'll look at what are homes like yours doing in this market? How many new listings coming to market? How fast are they being taken off the market? What is the pressure on prices? Is it in forward-looking absorption rate? Is it pushing prices higher? Are they pushing lower? Are they flat? And we've been very successful in using this methodology as data-driven, fact-based analysis to answer your question, what's the market doing? Having taught in this industry for over 20 years and progressing from the more persona-driven realtor, I'm trustworthy, I'm safe, I'm smart, I'm a local real estate expert, which was great, which is fine, and it served a lot of people, both consumers and producers, very well for many, many years. But we're in a new era. We're in a new time. The availability of data, the availability of information completely has transformed the realtor's role. Where we were the arbiters and the holders of the information in the past, now we're the people that are trusted to analyze and even predict, if you want to use that word, and consult our buyers and sellers. Most of the information that I've shown is accessible to most people, but where our experience in this market, in this industry, in this valley comes in handy is we can translate some of these trends into what is the price? What are the chances of prices going up or going down? How can you maximize the value of my home at a given moment? How can you help me buy property, not overpay, or even create value in a very tight market? It's what we're good at. It's what we love to do and how we would love to help you. So if you're listening on this, if someone forwards this to you and you listen to it because you're thinking about buying or selling, you are wondering who is best to reach out to. We do all the traditional things that other realtors do. Those are givens, in my opinion. There's minimum standards around staging and photography and videography and social media and all the things that were 10 years ago, those are leading edge things to do as a realtor. Today, it's the bare minimum. It's the basic package on how we help you buy and sell. The understanding of contracts, the negotiating of contracts, our expertise is there. Again, I've been privileged for over 20 years to work in this market, train and coach hundreds, if not thousands of agents on how to interpret markets, how to talk to buyers and sellers. So with me, you're getting it from the horse's mouth. And that's because on our team, when any of our partner agents works with you and it comes time to explain these numbers, explain trends, answer your tough questions, I hop on board. I'm happy to do it. I love to do it. I consider myself one of the leading experts in this valley on that. And I'd love to prove it to you, love to show you, again, answer your tough questions, get on a one-on-one, whether it's in person over a cup of coffee or like this on a Zoom. Don't be afraid of this market. Be careful when you read headlines. The headlines are generally talking about means, medians, and averages, not your particular property. They're usually regional in scope, whether it's national, statewide, or area wide. We were helping a buyer just 2 days ago. They were looking at properties in Mountain View, Sunnyvale, and Cambrian. And when they asked us our opinion of each one, there was 4 different answers because they were literally in 4 different markets. They were not in California. They were not in Santa Clara County. It is not that easy. Each one of those homes was in its own ecosystem of properties. And I'm happy to say we were able to get them a great deal on one of those properties. And I think it's because we were able to so diligently explain the differences in each market in a way they could understand and a way they could feel comfortable, even though they had a lot of questions. So when it's time for you to find out what your property is worth, thinking of selling, or you're in the market to buy, or you just want to know what's the state of my home, we're happy to help. Reach out to whoever invited you, whoever sent you this video, and schedule a time for the 3 of us or the 4 of us to sit down, go over this, completely tailored to your property, your needs, your wants, your timelines. So with that, I'll wish you a good night. Hop on next Thursday. The markets change every 7 days. We'll be here with new information, new trends, or if they're the same, you'll know that, you'll be comforted by that. All right. So good night, everybody. Reach out to anyone on the Let's Cruise team. We'll help you out. Eager to get started. Thank you.